broadcasting you live from Chicago, Illinois. And today is Monday. It is October 13th, 2025. Good morning, TheoTrade members. Usual suspects. Trains, hello. Carlos Anaya, he's been around a long time. Ship, how are you? Okay. Where's my good Guatemala? Haven't seen Michael Guillot, Ed Mines. Yes, Terry Palmer. Long time no see. Bart F, how are you? David H. Look, I've got too much to cover, and I got to bail because I got to teach a class today at Loyola. There's a big Loyola get-together yesterday at a Gibson's Bar and Steakhouse. If any of you have never been to Chicago, it is the most famous restaurant in all of Chicago. Number one, it's called Gibson's Bar. It's in the Viagra Triangle. It's right in the heart of Chicago in the Gold Coast. And the university picked up the bill to basically celebrate all the professors out there. And it was really nice that my boss came up to me and he called in front of like 70 people, called me a superstar, which was great. Because I helped bring in a lot of money to the university. It's all good. Without further ado, let me talk about the market first, and we'll get into the coaching session second. I want to hold off because I have a lot to say on this. So today's theme comes courtesy of Star Wars. I know every one of you've seen Star Wars. I know you've seen maybe 2 of them, 3 of them. Maybe you've seen all 9 of them, including the 10th one outside of it and a couple others, which is like, you know, the one with Han Solo called Solo. Okay, the George Lucas series. People, you all need to wake up here because I don't want to dumb this down at all. I'm sorry, Garrett. I'm sorry, Gianni. You guys are simply wrong. This is not the end, but it's the beginning of the end. There's a disturbance in the force. Now, you need to know the history behind this and need to understand, okay, where it comes from. So the original term disturbance in the force actually came from Obi-Wan Kenobi. Other people have said it along the way, but it's actually Obi-Wan Kenobi, at the time played by the great Sir Alec Guinness. And he says, quote, "I sense a great disturbance in the force." And he says, as if a million voices cried out in terror, and suddenly we're unable to like comment or post or anything about it. Okay, that's a joke right there. But it was this a million voices cried out in terror is what he said. And there's a reason why Obi says there's a disturbance in the force. So people like, what is the force? Well, the force is a powerful energy. It's an energy field which bounds all beings and can be sensed by force, what's called sensitive, meaning the Jedi. Feeling a disturbance in the force let one who felt it to know what was happening elsewhere in the galaxy. It channeled through the heart and mind. People, stop lying to yourself. All of you, stop it. Yep, Friday is not a one-off. Gianni, stop. It's not a one-off. It's a big deal. It's a harbinger. It's not a prediction of what's going to happen each day. That's not what it is. It's telling you that a correction's coming. It's going to be fierce. It's going to be brutal, and it's going to be protracted. That was day one. When we get to day 180, a lot of you are going to quit the business. You have never seen a market down as much as Don and I have during 2000, 2008. There is a disturbance in this force. Let me continue on. A person who senses a disturbance in the force usually senses what's called events of cataclysmic nature. People, I can sense it. I've been around a lot longer than most of you. I can see it. I can feel it. I don't care about 89 points today. It's garbage. It means nothing. It's an algorithmic manipulation. I don't care. Something horrible's happening. You can feel it. You can sense it. And the idea is once you sense the disturbance in the force, it reacts in pain, confusion, and there's empathetic mental anguish. There's many disturbances in the forces throughout all of the Star Wars books and trilogies, believe it or not. There's one with Jedi Knight Gela Natai, felt the disturbance caused by the death of Viceroy Farai at the hands of her friend Axel Greylark. It's another one. She mentally compared the feelings to disturbance to a weight pressing on her heart for a brief moment. People, the market isn't just about, okay, charts. You have to kind of put that aside. It's not about CNBC or Barstool Dave. People, a lot of the business is not gut. It's you're in tune with, you understand how the business operates. It goes up, it goes down, it goes up, it goes down. The idea that you think this goes up forever is nonsense. You're just lying to yourself. You don't look very intelligent. I'm telling you, we're going to get a correction at some point. May not be tomorrow, may not be November, but you got to get ready for it, which is why I'm going to talk about drawdowns. So if you recall, the Death Star, which was built at the hands of the Emperor and the Sith and Darth Vader overseeing the plans of building the Death Star, the Death Star actually took down, it destroyed the planet Alderaan. So the destruction of Alderaan, which is actually the home planet of, I think it was Luke Skywalker, or originally, was also known as the Battle of Alderaan, which occurred at the order of the Grand Moff Tarkin in order to demonstrate the destructive power of the first Death Star. The incident resulted in complete annihilation of Alderaan and the death of all its inhabitants. So if you watch Star Wars, you're not foreign to this, you're not blind to this, you're seeing this. Now, this is just merely, it's an analogy, it's an allegory. This is what I do. I love to colorize, okay? It starts with a disturbance in the force. This market is a force. It's a force, people. It's a force of algorithms, liquidity, perma-bullishness, video games, AI, narrative, CNBC, social media. It's a gigantic tidal wave of a force. But Friday, even though it was just, you may call it a one-off when, Trump comes in and says, well, we got a problem. We're going to raise the Chinese tariffs 100%. I know what you're thinking. I know. Oh, it's down 227. Oh, time to buy. Okay. You're getting off kilter. You're not understanding. This is the beginning of multiple disturbances that are going to happen in this force that's going to force this market into a corrective mode. And it's the healthiest thing that's ever going to happen. And I'm preparing all of you for it. I can see it. I can feel it. I was basically walking home, looking at it. I saw the market down 200 and I was like, it's coming. And I thought it'll be up on Monday. There it is. It'll be up on Monday. The news media will run with it. And you're thinking we're past this. We're not even close. Now, understand the macro catalysts here. Temper. Get the little pun there. There's pun. Get it? Temper. I'm trying to temper your negativity. U.S. stocks firmed because Trump downplayed the Chinese threats. Trump's like, he comes out on the weekend and he says, you're all overreacting. I'm not going to slap it on the Chinese that bad. Okay, people, stop. It's too late. It's going to happen over and over and over again. And if it isn't the Chinese tariffs, it's going to come from somewhere. There's going to be something. It's going to come from Jeffries. It's going to come from a run on banks. This is the beginning of a crack in the force that's going to blow this market apart at some point. So we may just bounce around here 90 points, and I don't care. The downside is lethal. I want all of you to recognize that and get hedged. The Genesis Cog is absolutely killing it. We're short Fastenal. We're short everything virtually that's getting blown out. Today, when the market's up, we got a handle on this. So we're hedged long, we're hedged short. And believe it or not, on Friday, my short portfolio against the long showed a profit. How many of you can raise your hands and showed a profit when you're net long and you had some shorts, more longs and shorts? We were up on Friday. Up. We have a handle on this. We can see this. We can read the risk. We can read, can't predict minute by minute, but we understand what we're up against. So this is why the market rebounded today. Now, juxtaposition, flip it. A number of analysts came out this weekend, and I've got the article. If you want to read it, I highly suggest it. One of them is on Morningstar, one's on Barron's, one's on Bloomberg. They're all over the place. A number of analysts are opining that the current stock market is the dumbest stock market in history. It is the dumbest stock. All of this, what's going on, is ridiculously stupid, and yet it keeps going higher. Okay, so your attitude is, if you can't beat them, join them. It's like Bugs Bunny. Why is this the dumbest market ever, quote unquote? The reason is because at this point, the market's running for a number of reasons. Number one is passive investing is dumbing people's brains. It's saying, don't do any fundamental research, just buy what's in the index. That's why it's dumb. It's like, well, if that's the case, everybody should be doing it and we're never going down. Well, now we're starting to go down. So you're realizing that the market's been dumbed down by these managers going, well, I'll just buy whatever's in the index of the greatest magnitude and the greatest market cap and I'll make money. Sure, until it doesn't work. You're being fooled. It's gonna implode at some point. You can't live forever on the same type of like strategy. It just doesn't work. You have to adapt strategies to markets. It's a fact. That's one reason why it's dumb. Okay. They're also citing other reasons. Another reason why this market's so dumb that these analysts are saying is because as data gets worse and worse and worse and worse, more and more people are buying the market. Slowdown in jobs, higher inflation, a Fed that's completely lost, and the market's like, these things don't matter. And what they're saying by dumb is not that it's not intelligent, it's that they're dumb in terms of like, they're just dumbing it down, thinking none of this stuff matters anymore when it really, really does. So I find it, I call it dumb and dumber because it's so ridiculous. A third reason why these analysts are saying this market's going to implode. It's trading at 26 times trailing earnings, far above historic norms. It sells for 40 times inflation-adjusted earnings of the past 10 years. This market is 100% overpriced. 100% overpriced. Screw Bierman, I'll buy. Then you buy and I'll sit back and watch you buy. I do not care. I want nothing to do with this because when it goes down, the speed of the fall, it'll be slow like Don says, and then the floodgates tend to open on this stuff. Again, it's up today and I don't even care. I figured it would be up today. So the value of the market, it's overvalued. The indexing is causing like obfuscation. You've got the Fed who's lowering interest rates and a rising. There's like 100 reasons. So I'm going to leave it at this. It's the dumbest market in history. And yet people keep buying. I'm going to tell you this again. It's bizarro. You keep buying when the data gets worse. You're eventually going to get caught. There's an expression by Yale Hirsch. You can fool the market some of the time, but you can't fool it all the time. A lot of you are being fooled to thinking that this is going to continue. Okay. It's not. It may continue a little while longer, but eventually they're going to get this market and they're going to beat it hard, hard. I can see it. I can feel the disturbance in the force. It's not a gut. It's experience because I've lived through crashes all my life. Three's Company. The Fed is in a fret. The Fed came out today and they said, I call it Three's Company because there's three things. The Fed is worried about the risk of tariffs, and yet they're cutting rates. The Fed is worried about an AI bubble, and everybody knows we're in an AI bubble. It ain't no different than the internet bubble. No different, people. Sorry, same thing, different year. And then you have the soaring debt problem, and now they're starting to unwind all of this soaring debt at both the private equity and the public equity. Jeffrey's got caught. They got burned on first brands. That's the first chocolate-covered hanger net. There's more coming. It's the cockroach theory. Jeffrey's got burned. You know there's another 100 companies going to come out, small and large, and they're going to warn about their debt problem and the pricing and liquidity of debt, which is going to unwind a lot of and unravel the financial system and cause some type of dent in the market. Friday, I said the market was feeling like a mere flesh wound. That flesh wound is now going to become like a death by 1,000 cuts. Don't treat the market like it's a flesh wound. Start to comb over your whole portfolio and track the behavior of your stocks, which is what I do every day. And make sure you don't get complacent, you don't panic, but you recognize what's in trouble and what's opportunistic. I'm going to bring this to your attention, okay? The Genesis COG has been crowing about this. I've been standing up every day to the Genesis COG members, and I kept saying, they're going to get this stock, they're going to blow this sucker out, they're going to eventually get Fastenal, okay? Get ready, get ready. Bam, there it goes. Whoops, there it is. Didn't I tell you? The stock is ridiculously overpriced. The earnings came out today. I stepped in and said, well, I'll just buy a call option. I'll waste $100, which is what I did to protect my 200 share short. There it is. So I lost 200 to make effectively 600. I'm 400 ahead. Okay. The company missed by a penny. I call it unfastened. I'm going to tell you right now, based upon my work as an analyst, as a former portfolio manager, and as a finance professor at an accredited university, a lot of you have no idea what you're up against. This is the beginning of the end of hundreds of stocks that a lot of you own. You don't understand. You're buying stocks that are massively overpriced. Now, for me, I don't see the financials as massively overpriced. I don't. You can't convince me of that. This is a joke. Not only did they miss their number, but they're still trading at a 41 multiple when the company's only growing and it's declining. Earnings are declining. Look, they're declining earnings. and the television people were ballyhooing this saying, buy Fastenal. That was the easiest short I've had in the last 10 years of my trading career here. Easiest. I don't care about the crap. The chart's worthless. All I care about is use the chart for an entry point and then attack this bubble. I've got dozens of bubbles. Join the Genesis Cog, Genesis Cog. I'll give them all to you people. There are so many out there. This is one of what's going to be morphed into dozens and dozens and more and more and more bubbles that are going to burst. This is blown out. So all I advised Genesis Cog members was take off half today, let the rest ride, which is what I did. My options are going to expire worthless. I got a 47.550. That will expire worthless in 10 days. It'll be worthless. Okay. This is the beginning of the end of what it looks like. You haven't seen it yet, but you're going to see it on the E-mini eventually. That's what it looks like. You're going to see this sideways flag, then the bottom falls out. The MACD is never wrong. You are. I keep telling you this. There is a Genesis Cog. We call this one unfastened because it's now blown out. Here's another one today. Morgan Stanley has officially, and God knows why, what are they thinking? The worst possible time you could ever do this. It's like giving gasoline and a match to a pyromaniac. It's like throwing gasoline on a bonfire. Morgan Stanley has now officially opened the door for all clients, even clients who are not even sophisticated, to trade basically crypto. They want clients using crypto not only to trade, but using crypto as an asset class to up the ante on their margin. They're using crypto for margin. So here's what happens. When crypto gets unwound, stocks are sucked down like a vacuum because now they're correlated. In other words, if you're using stock or cash to back up margin, I get it. I've been in the brokerage side of the business for a dozen years. I know. But now they're encouraging their clients to get into crypto. Like they held off for 10 years. And this weekend, Morgan Stanley's like, crypto for everyone. So I call this, tied to this one, I call this one kryptonite. Because eventually crypto is going to be like Superman. It's going to be the kryptonite that drags the market down. I met some of the professors on the weekend who asked me, I saw you in Market Watch. I saw you on Yahoo. What's your take on the market? And I said, I can't pick the day, but I can tell you this. Somebody said, what's going to be the straw that breaks the camel's back? Crypto. It's going to be the one. It's not going to be housing market. It's not going to be, AI. I don't think AI, even AI is a bubble, won't even do it. I think crypto is going to be like, that's going to be the vacuum. The magnet's going to kill it. When it breaks 110, it's like air to 80 and all the market just is all correlated with it because it's all being used to prop up the market's liquidity. It's like a systemic sucking sound of a vacuum cleaner. You better be on your guard here, people. Don't treat today as a one-off. Please, I promise you, you're not seeing the disturbance in the force that guys like me and Don and Brandon, Blake, we see these things. Okay, we've been around a long time. The market's not going to implode in a day. It's not. It's going to take a while to break the back of the market, but it's going to come in pieces and pockets. So every time there's a disturbance in force, I'm going to tell you, here's another disturbance. Here's another disturbance. That long 227-point candle, that is not what I call, it's a one-off. No, no, no. It is an extraordinary candle that's sending a message, something in this parabolic universe of liquidity in the Fed and the one-sidedness. At some point, it's going to become that two-sided, and the over-leveraging is what draws it down. It doesn't have to be like a fundamental. It's just the leverage factor is like a cement kite that just drags it down. Be careful of this. Love Shack Baby. That comes from the B-52s. Love Shack, baby, love Shack. All right. So at one point, the Genesis Cog was short this stock. We got short in that 140 area. We covered between 122 and 130. We did great. I took strictly an option position, nothing else. Okay. Just strictly an option position, nothing else. Haven't been in it since. Why do I bring this up? Because for some apparent reason, Jeffries just could not control their bowel movements. Maybe they need some Depends. And Jeffries said, we're going to initiate a buy on Shake Shack. They put a buy on it. And they put a $110 target price. Jeffries did. Jeffries the one who got slammed. Upgrade Shake Shack to hold from underperform. Okay? Let me explain something to you. This is what makes analysts nowadays, to me, worthless. Okay? Have any of you looked at Jeffrey's valuation? Any of you? Jeffrey's up here was trading at 180 times earnings. Have you seen what it's trading for now? Because I double checked it. It actually trades at about 150 to 160 times earnings. And Jeffrey's put a buy on it. If you worked for me, I'd fire you. Are you out of your mind? I'm not going to ever put a buy on 191 multiple if it ain't a tech stock or it ain't a biotech stock that's got a cure for cancer. You're out of your mind. They just simply sell crappy burgers and good shakes and crappy fries, and that's it. You're better off buying McDonald's and not betting the farm. I can't believe they put a buy on this. Their thinking is it's oversold enough. Let's put a buy on it. I wouldn't buy this with your money. There's no amount of upgrades. They could put 100 upgrades. I wouldn't pay a penny for this. I'm not buying a food stock at 191 earnings. That is the equivalent of Peloton at 155, and Peloton can't get off the toilet because it's a piece of crap at $7. That's what it's worth. Shake Shack's not even worth 20 bucks, people, and yet Jeffries is like, let's put a buy on this. Really? You're going to rope in some more suckers like you roped them in at 144? I advise you, don't ignore Jeffries, but ignore this. Do not buy that. So don't short it, because you can't short oversold in the Genesis Cog universe. You cannot. You cannot short oversold. It is illegal in my universe. But you cannot buy that stock. It is not bargain hunting. It's bottom fishing a crap stock. I'm telling you, this is what gets a lot of you in trouble. You see the upgrade, you see it oversold, and you're thinking zigzag buy. If you can't price it, don't trade it. That's a Bierman rule. You can't price it, you have no business trading that stock. I'm telling you. If you can't price it, avoid it. I'm telling you. Next on the list here, I'm a no-nonsense guy. All right, next on the list here is this. Last but not least, okay, Fireball Firewall. Yet another. This is why analysts, again, I see in 5 years, there's no more people analysts. It's just all AI. It'll be like a robo, like Upgrade came from this AI robot number 11265. There'll be no people. They're going to have to get rid of all analysts eventually. I can't stand anymore. Why in the hell would they upgrade Palo Alto? Upgrade. They're upgrading it at an all-time high. Upgrading it. Okay? Have you seen how expensive the stock is? Add the last 4 quarters. Just add them up. So they earned about, what, $3? Technically, this is trading at about 60 times earnings. About 60 times earnings, or a little higher, 65 times earnings. Why would I buy this stock when I could buy Apple? I could buy Palantir. I could buy NVIDIA. They're all trading at half the cost, half the valuation, Meta, and they've got a higher growth rate. This is a cybersecurity company. Once again, my position is this, and you can disagree with me and you can scream at me and I'll take the abuse. They're upgrading it to sell it because they know it's going to blow. It's a setup for a complete collapse on this stock. People, the secret sauce is the weekly indicator. It will not fail you. It's made us a fortune at Genesis Cog. The weekly indicator is still on the way up. So it's unshortable. We do not short on the way up. That's why we don't get blown out. That's our secret. We don't short on the way up. Let it play. But once this flattens out, all I see is absolute pain for this stock. Okay? Upgrading a stock at an all-time high when we just had a correction. It's like you can't control yourself. Oh, we got to get them to buy this stock. They're upgrading it to sell it, people. That's what they do. They upgrade it to sell it. And sometimes they downgrade at the bottom because they want you to sell it so they can buy it because they want to take it back up. This is use the upgrade to sell the stock. Sell the stock, get out of the stock, and walk away. People, the market's up 359 on the NASDAQ today. I just don't care. Last thing I want to throw out is this. Look at the S&P 500 right now. Okay? I said this on Friday, and I'm standing by it. I am not going to get bearish on the S&P. And I was right. I was right not to short it unless it goes below 6,500. That's my line of defense. 6,500 here. and 63.50 there, 6,300, right at 62.50. Those are my two lines of defense. That's it. If we don't go through this, if I were you, I would not short. I certainly wouldn't buy it. I just wouldn't short it because you can get done. Look, you shorted. How well that work out for you? It didn't. It's when the MACD rolls over. That's the key. If that MACD rolls and curls and heads down, you're going to lose a lot of money. And if you don't believe me, I'm the one who called Fastenal because it's going down. Look at it going down. It looks like a waterfall. See that? That's how I cleaned up for the Genesis Cog members. The integrity of the slope is what makes you wealthy or makes you poor. As soon as the S&P 500 curls over and it starts, we're close. That's the disturbance in the force. We're very close to, we're not there yet. We're close. We're like a month or two away. We're close. But once this goes through and comes out the other side and breaks underneath 6,200 people, okay, I'll say this again for the 100, you're not getting out. You're a deer in the headlights. You're done. You're in a cave and you're blind and you got no flashlight. You're done. Take the time now to lighten up. Either short this product while it's up, like the two-sided market. It was up 100. You could have shorted it and scalped for 70. I'm short. Whatever popped this morning, I'm shorting. I just don't care. I don't care. Whatever needs to break down, I'll add more to it. Okay. I'm short Southern Company. There's one of the Genesis Cog trades ready to roll over. Here's another one. Monster Beverage. There's a Genesis Cog trade right there. Everything we're short's going down, people, because we wait until the curve starts. When it starts, we act on it. It's one of our primary shorts, people. Can I tell you? Don't short on the way up, on the way down. For the S&P, the key number, 62 to 62.50. We go through that. I'm declaring the bull market's over. It is over. It's not over yet, but we're getting really close. There's a disturbance in the force. Now, without further ado, what we're going to do today is a special program. You may hate me. I don't care. Somebody needs to address this, and I'm the one in the room who's going to do it. I don't think the market's going to crash. That's not going to happen. But I don't think we're going down a lot. We're going to have to correct a while. We're going to talk about drawdowns. I'm not going to make friends with half of you. I know that. All of you Gianni supporters are going to tell me, get Bierman fired. Go ahead. I defy you. Go for it. But Uncle Jeffrey comes with the proof. So sit down, hang out. It's going to take about a week. And I'm going to walk you through. It's called Look Out Below. Look out below! Tools to measure market drawdowns. I'm not predicting where this is going. That's a fool's errand, people. But I can tell you this. I'm going to introduce you to my set of tools so you can cut your teeth, the cut of my jib, and you can figure out how much money you're going to make or lose depending upon how far it falls. I'll give you a lot to work with, and I'll have a drawdown lesson at the end of the program. So take about a week. We're going to talk about drawdowns. What the hell is a drawdown? Oh, there's a lot to talk about, people here. So I'm going to remove all this because we don't need any of this stuff. We don't need no stinking technicals today. And we're going to go into the 20-year monthly, and we're going to go into the SPX, and we're going to talk about drawdowns. So people say, educate me, Homer. That's what Homer used to say. Educate me, Marge. So I'm going to educate you. What the heck is a drawdown? So let's draw the word, and there's max drawdowns, min drawdowns. I don't want to go too far deep into that, but we're going to talk about drawdowns. You need to know what this is. There's no better time for me to address this subject than today. If I do it after the market drops 20%, I'm useless to you. I should be fired. Hey, your house burned down. Should have bought a fire alarm. How is that going to help you? You pay us to get you ahead of the curve. That's what we do. I'm getting you way ahead of this curve, and it's going to be nasty. Nasty curve. You can just, again, it's going to be nasty. An investment drawdown refers to the decline in the value of an investment from its peak to its lowest point, and it serves as a critical risk and volatility measure. So the word drawdown is a fancy word for risk, but the term drawdown means risk in one direction. That direction. That's the risk we're talking about. It's the risk from high to low, not low to high. Drawdown means down. You're at a certain level, a certain height, a certain peak, a certain benchmark, and you're going down. You need to know how far you can fall off that mountain. I've met a lot of people in my lifetime. I've counseled thousands. I work for Thinkorswim. I've done work consulting privately at Theo. I've seen people lose a lot of money for one reason. They don't think risk. Everything is return. It's return, return, return. This is the day where I'm going to change all of you. Forget return. It's irrelevant. Think about risk, because there ain't no return if you mismanage the risk. You will never get a return. The risk will take you apart. You have to be realistic. You have to measure the risk and then make whatever decision you want to play with. You got to do it that way. So a drawdown is defined as what's called peak to trough decline in the price of an investment, fund, stock, or portfolio. It is typically expressed as a percentage, and it's used to assess the historical risk associated with an investment. So for example, if an investment value drops from 100,000 to 80,000, okay, what would the drawdown, how would you calculate the drawdown? Let me show you how you would calculate the drawdown. I will show you. The drawdown calculation looks like this. Drawdown mathematically is peak value minus trough value, means peak is the top, apex, trough is the bottom or the nadir, right? Okay, divided by the peak value times 100%, because you have to percentage it. So obviously, when you take the figures and you plug it in this formula, what you're doing is you're taking the peak value of the portfolio, which is 100,000. You're subtracting, you're going to the trough value, which is effectively 80,000, which leaves you with 20,000. And then you divide that 20,000 over the 100,000, and then you multiply it by 100%, which means the drawdown is 20%. 20% drawdown. This is the formula all of you need to integrate into your spreadsheets, even you Canadian computer engineering geeks. Get this in your, to do this for every single stock, every single portfolio, okay? Track the peak performance, track the bottom performance. Do a simulation. Run the simulations over and over again. You need to come to your senses, because this isn't an exercise in what's called hypothesis or potential. It's an exercise in reality that's going to happen eventually. And if you're not ready for it, it's going to hit you like a ton of bricks, and it's going to freak you out. And it's going to be hard for you to dial in day to day to TheoTrade to deal with this. I want you to be a member forever. We do. But you have to come to the realization, even Gianni, markets do not go up forever. They do come down. As Garrett says, markets are, I'm in the market for one reason: to sell. Stuff goes up, I'm out. Get me out. I want out. I make a lot of money, I get out. And when it's up, I want to short it and write it down. I love selling. It's my favorite thing. So what's the importance of the drawdown? There's three importance of drawdowns. Okay. Here are your importance of the drawdowns. Drawdowns, importance. Number one, okay, risk assessment. In this sense, hang on. Number two is investment strategy. Number three is performance evaluation. So let me bring this to you, because this is a multi-day program, I keep telling you. So the first thing I want to throw out is this. Activate the drawing, text note 2, drag it down, okay? Drawdowns provide insight into the maximum potential loss an investor or trader might face, okay? Might face during a downturn, allowing for better risk management strategies, okay? Number two, investment strategy. Investors can use drawdown data to inform their asset allocation decisions, particularly in balancing high risk and low risk investments. So it helps you do what? Tweak your investment strategy. It's not that, get me out of the market. Wrong. That's not what you do it for. You don't exit completely. You basically use drawdowns to tweak and massage your overall portfolio weighting of stocks, bonds, long and short positions in crypto. That's what you do. That's how I'm doing it. Number three, performance evaluation. Drawdown metrics can be used to evaluate the performance of investment managers and strategies, highlighting how well they manage risk during market fluctuations. If your drawdown is greater than like 25, 35%, I wouldn't give you a penny of my money ever. I can't stand drawdowns of more than 10%. My worst drawdown the last few years is about 7%. I try to contain as much damage as possible in a drawdown with long positions. It ain't about being a hero, people. It's about being a survivor. Drawdowns crush people. They separate the smart from the egotistical. They expose you completely because a drawdown's going to come. You can't stop it. The algos are going to initiate it and just keep beating on your brain every day. The most important thing is staying in the game, not getting emotional, accepting that it's a real part of the business, right? And that you've basically prepared for it. So when it does come, you're not feeling the heat. You're like, I'm down 5%. The market's down 30. You've done a fabulous job. Losing money in that vein is good because you're losing a fraction of what the overall average market is. That's why you're doing it. People say, well, what contributes to market drawdowns? Market volatility, economic conditions, corporate performance, and investor behavior. All of them go into and are cycled into variables and catalysts that create this market volatility. The market itself right now is not feeling any fear whatsoever. The fix is at 20. So the hell what? Take it to an 80. Then you got my attention. You ain't feeling fear, people, because if you're feeling fear, that's above 30. What the market's doing is it's like, well, we're buying even when the fear is out there because we figure if the algos keep defending, it'll keep holding. Screw the VIX. The VIX is a lagging indicator, people. It ain't a leading indicator. It's not. So I'm just bringing that to you. So in summary, the drawdown is a vital concept in trading and investment management that helps traders understand the risks associated with their overall portfolio. By analyzing drawdowns, you can make more informed decisions about your investment strategy, your particular risk tolerance, making adjustments and from high beta to low beta and vice versa, and ultimately leading to better financial outcomes. That's the importance of why I'm talking about this. Now, let me bring some statistics for you to digest. Okay, I want you to sit and I want you to absorb this and digest. Sit back, TheoTrade members. I keep telling all of you, CNBC, the guests will lie. They will spin. They will spin. Bloomberg spins. Social media spins. They tweak your brain and dopamine. They confirmation, the biases. They get you to hear what they want to hear. Stop. Focus only on one thing. Don't worry about me. The facts never lie. Numbers do not lie. People do. Here's some of the facts I'm going to toss your way. Number one, when I talk about a drawdown, instead of focusing on one individual stock, NVIDIA, Microsoft, Apple, Tesla, forget it. Those are not the type of drawdowns I'm talking about. The drawdown we're referring to is the index as it correlates to your overall performance portfolio. So we're talking about the S&P 500. We're talking about the Dow. That's what we're not talking about the NASDAQ. The S&P 500, which is a broad 500 stocks, 11 different categories, and the Dow, which is like Noah's Ark of like 11 different categories, except it doesn't have REITs. So let me get this out in the open. This is a chart of the drawdowns since World War II. So it goes all the way back to December 1947 to December 2022. So you have 3 years of no drawdowns, but there are no drawdowns in the last 3 years. So it's perfect timing. There are 0 drawdowns, none. So the fact that it stops at December 2022 and we're like, but we're 3 years into it, doesn't matter. There's no drawdowns. We just keep going up. But what about what happened during Trump? That's not even a drawdown. It's barely a drawdown. Drawdowns are when you go down and like a boxer, you get haymaker, you go down and you don't get up for a while. You just don't get up. Look at the drawdowns across there. Now, this is all I want to point out. We're not going to go through every drawdown here. I just want to show you the pain trade. The pain trade. So here's a drawdown of 20% back in 1950, 1949. Standard, right? Bear market. Because bear market by definition is what? It's a drawdown of what? 20%. There's your bear market. Peak to trough, 20%. Bear market. Check. Okay, you got a few of them. Here's a drawdown of, 1947, 28%. Here's a drawdown, 20%. Here's a drawdown in 1956, 20%. Okay. Here's a drawdown over here, a 1960, 62, drawdowns 30%. Okay. I just want to go to the deepest ones. So here is 2008. There's a drawdown of 58% of the S&P from top to bottom. 58. Let's go to the dot-com era. Okay. Here's a drawdown close to 50% on the S&P. Okay. There's your drawdown. Peak to trough. Peak, it hit the all-time high to the bottom. Okay. Here's a drawdown in 1974, oil embargo, President Nixon, Gerald Ford, blah, 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 high inflation, oil, blah, blah, blah. Here's a 50% drawdown, 50%. Okay. And then we'll go over here to December COVID, where there's a 34% drawdown. Okay. I just want to throw this out. Okay. What's my point about this? Okay. Here is my point. Drawdowns occur on average every, let's say, 2 to 5 years. You're going to get it. There's a long time period between here and here, but here's 01 to 08. There's 7 years between there. Here's a drawdown from here to here. Okay, here's a drawdown. Most drawdowns of significance, not a drawdown of 10%, a drawdown of 15%. Those are garden variety. I mean, ones that are really mess you up and go, I'm never coming back. I quit. Okay, they tend to occur once every, let's say, 5 years. Real drawdowns. When was the last time we had a real drawdown? Okay, it was 2022. Now we're up upon 2025. So that's a 3-year hiatus. Not a big deal. But what you're beginning to see in these drawdowns is that you have to see the average. Because when you see the average, it's going to turn all of you upside down. When you see the average, a lot of you are going to go, oh, you know what? I should listen to Bierman. Because the averages don't lie. People do. So this is just, again, drawdowns occur. And the drawdowns can be 50 or 60%. That's the first. I want to shock and awe. 30, 50, 50. If this doesn't catch your attention, I'm never going to get you. Because we're going to have a drawdown at some point in the next 3 to 4 years of this significance of 30 to 40%. Are you ready for it? Because I am. I think it's coming sooner than later. Inflation's out of control. The Fed's out of control. AI's a bubble. The market's 100% overvalued. We're there. It's ripe. All we have to do is turn the technicals upside down, and it's all over. Because these things usually occur very fast and furious. That's the first thing I want to throw out. The next data I want to throw out. Next data point I want to throw out. Largest S&P drawdowns, okay, by year. By year. I've got a few more of these. So bear with me here. This is from 1928 all the way to 2018. 19. It goes 2019. Okay. These are the drawdowns year by year by year. Now you look through most of these, you're like, there's not that big of a drawdown. Well, the 2008 drawdown was 48%. That means if you had a $100,000 portfolio. At the bottom, it's worth about $50,000, give or take. And to make up that 50% loss, you have, or whatever that loss is, you got to make 100%. And that doesn't happen quite often. Okay. Here's another one, 1988. Here's the dot-com drawdown, couple years. Okay. The importance of this isn't the decline. That's not why I bring up this chart. It's the average. Look at the average over almost 100 years. It's about 90 years, a little more than 90 years. Okay. 90 years of drawdowns. The average drawdown is 16.3%. So what am I trying to communicate to all of you? We're going to get a drawdown probably somewhere between 15 and 20% this next leg down. Are you ready for it? I am. Are you? I'm just challenging you. Let's be 5%. The more overbought you get, the deeper the drawdown. You get my point here? 4,800 to 6,800, we're going down, people. What would be a 16% drawdown from where we are now? Take us into the low 5,000s. Are you ready for it? The CNBC is, nobody out there is. They're bullish. Let's buy this dip. That's what they all said out there, all the brokers. Of course they're going to say buy the dip so they can get out. It's coming, people. So there you go. The average is 16.3%. That's why I brought this up. But then there's more. There's more. Yep, there's more. Take a look at this, baby. This is the max drawdowns from year to year. And there's only one thing I want you to get out of this, okay? This is 1950 to 2024. So what I brought you was 1928 to 2019. The average drawdown was 16%. In this, it's a smaller sample set. This sample set, 75 years. It's more recent. The average drawdown is 13%. Even on a 13% drawdown, that would take us to about 5,500. So you should expect that. The average annual return over this period has been 11.6%, which is good. But in a drawdown of 13.6%, and this, you need to make that up in short order. So these are all the drawdowns, intra-year and end-of-the-year drawdowns. And you can see like, hey, here's a 37% drawdown 2008. Okay, drawdown 48%, but the total return is 37%. So this one recovered 18%. Here's a drawdown 2022 where we were down. The drawdown was 25% from peak to trough, but we actually only ended down 18% because we recovered almost 7%. So this was the total return. That's the drawdown. So you can see that here is one where the drawdown was 10%, but we still ended up 26%. Here's a drawdown of 8%, but we still ended up 25%. But the thing about this is, okay, what's the message of this particular graphic? Why am I giving this to you? For one reason. Because every single year, what do you have? A drawdown. You're getting a drawdown. Stop, people. You haven't had a drawdown in 7 months. It's coming. You're going to get another one. You know it's coming because there's always a drawdown. But we went from, in April, down from like, 5,600 to 4,800. BFD. Oh, be still my heart. 800-point drawdown. It's barely like 13%. Just wait, people, because another 13.8% might still come and be worse. Look at these drawdowns during the high beta years and the tech years. 2000, 17%, 2001. Okay, drawdowns of 9 and 7%, that's not realistic. Start to figure. Here's a 17% drawdown earlier this year. Start to realize that the higher we go, the farther we fall. The higher we can bounce, which is good, but the farther we fall. That's why I'm bringing this to your living room. But I'm not done yet. Oh, no. Another data point for you. People like, he's nuts. No, I'm just trying to bring to you the factoid facts to deal with. I've got 2 more to show you, and then I'm going to move on to grab some lunch and run down the lane. I can't take the bus because I can walk there faster. And by the way, they had the Chicago Marathon here yesterday, by the way. Streets were all closed. Okay. The S&P has experienced a median. People like, oh no, there he goes again with those fancy things. I can't handle Bierman. It's too fancy. The median. Stop. The median, the mode, the mean is the average. The mode is the most popular sample set that populates. The median's the midpoint between high to low. It's just the midpoint. It's not the average. It's the midpoint. So the S&P has experienced a median annual drawdown of 10% during the last 40 years. So 2025 back to 1980, including the Trump tariff drawdown earlier this year of 17.5%, including that, okay, the median drawdown's 10%. The median, which it's the midpoint. How much have we gone down? Be still my heart. We're actually down 1%, 1.5%. You have 8.5% to go, TheoTrade members. You do. You know you do. So stop lying to yourself and me. You're going to get 8.5%. Because once you break on one of those Maribosas, which we got, okay, the next day I don't give a crap. We're going to get likely a 10% drawdown. Are you ready for it? Statistics, I'm not color. This is not me like skewing. This is raw numbers. The calendar peak to trough drawdowns. The median is 10%. And the higher you go, the farther you fall. Here's the drawdown over here of that 48%er back in 2008 in the housing crisis. This one was like the drawdown this year was barely, and we already came back. Okay, we need a drawdown. It's coming 20 and beyond. It's just itching for it. It happens pretty much every 3 to 5 years where we go beyond the 10 and we go to the 20. We're right on that probability occurrence. It's coming, people. It's coming. We're right on that occurrence. It's coming right at you, people. I'm telling you that right now. Last but not least, and this to me is my favorite one of all of them. Got 5 minutes to go, so let's just see how far we can take this. Ready? This is S&P drawdowns, the top 10 from 1951 to 2016. But I don't care about the depth. That's not the focal point of this one ain't the depth, people. Stop. It's not the depth. The focal point of this particular slide is what, people? Duration. Time. Ooh, that'll mess all of you up. How long does it take to recover when a drawdown occurs? What if we get a 25 to 30% drawdown in the next 2 months because Powell screws up? How long will it take to break even, to come back to glory from the peak? This says it all, people. During the 2007 to 2009 housing crisis, it took 1,021 days to recovery. The length was 1,376 to length to trough. So when you take the length and you subtract to the trough and you subtract that out, you get 1,021 from trough recovery. That's 3 years, or a little bit less than 3 years to recover. About. See that? 3 years to recover to the new high, to the old high. 2000 dot-com bubble, okay, peak to trough, 1,166 days. Look at the length of that drawdown. The drawdown was 1,898 days, okay, before it gets to that trough, and then it starts to fight its way back. Okay, 1990, you can see all these. All I'm trying to tell you is that on a 27% drawdown, okay, this one, the length of this drawdown was about 488 days. Full recovery, okay, from length to trough, 58 days. So again, let's just say we fell 20%. We could come back in 60 days. We could. I'm not dismissing it at all. I'm not dismissing it at all. Can. But what's the likelihood of that when you're at much a higher high? See, when they recovered from this 1980, we were at a much lower high. See, it's easy to recover from lower highs, like the 400 days and 451 days. Like, that's a year and a half. That's what I keep telling you. You're not getting your money back. I keep telling you this. If we go through to recover, you're going to lose time, margin. The time value of the money is going to wipe you away. You're like, I recovered in 400 days. No, you didn't. Because the time value of money means you have to double your losses. It'll take you twice as much to recover because of the time value of money, of the discount rate. That's what I teach in corporate finance. These numbers don't take into account inflation. So they're even worse. They're even worse. Be prepared on a drawdown that the recovery is not going to be fast. That's the message of the graphic. I'm just trying to tell you, I don't know how long it's going to take, but based upon the averages, man, it's going to take a long time for you to make your money back. I own the S&P. Bierman's a moron. When it goes to 5,000, I'm going to make my money back in a month. No, you're not. 2 months. No, you're not. You may never make it back. Or it might take you 3 or 4 or 5 years to make it back to break even. Think about all the money you've lost, all the time value, the opportunity to earn interest, dividends, trade other stocks. People, the drawdown is not something you take lightly. It's not. So my goal for the rest of this week is to back away from stats because I'm done with stats. My job, my goal is to get you front and center to look at every tool I look at. I'm going to give you every one of the Bierman tools. Take one, take them all. Run with it. Send me a love letter. All I want you is to take the tools, measure the drawdown, and you tell me how bad you think this is going to get. And when you close your eyes, when you go through each one, you're like, wait, this one says it could go lower. Wait, this one says it could go lower. You keep piling up all the tools. You're like, holy crap, this is serious. You're damn right it's serious. Every one of these tools, some are more conservative, some have more latitude, some are more volatile, some are more, they vary. Take whatever you want, but they all do one thing. They map volatility and allows you to anticipate a drawdown. And if you can anticipate the pain, then tell me to go screw myself and say, I'm going to ride it out. I'm only going to lose 10%. Okay, sure. I'm telling you, measure twice, cut once. Measure the risk of the drawdown, and then tell me whether or not you're going to take that trade. Oh, I doubt you will. People, I lost millions to tell you. I measure drawdowns on everything. Why? Because I don't want to take the ride to hell like we all have. I don't want to take that ride to hell again. It's going to happen eventually for a lot of people if you don't measure the volatility of drawdowns. That's why I'm doing this. we'll go through each tool. We'll do the price level tool, standard deviation tomorrow. Okay. We'll do linear regression 100% and Bollinger Bands. Each day that goes by, we'll introduce a tool or two and we'll mine this thing out. In the meantime, the market's running higher. And I'm sure Gianni DePoce is sitting out there going, yeah, I told you we were going to rally. And I'm like, Gianni, I really don't care because all my short trades are getting annihilated. So I just don't. I'm riding the shorts to hell, right? So I just don't
Wait,
care.
did you say your shorts are getting annihilated or they're doing
No,
well?
they're just running. They're the shorts. I have one short that's not working, and they're all working. All of
Oh,
them.
well, that's what matters. All that matters is that your positions are working.
Yeah, but I look at today, Gianni, and all I see is like people trying to climb back in because it's a generation. I don't see this as a generational buying opportunity. I see this as like the perfect point where you're like, whoa, I got a reprieve from death. I got half my money back. Now get out. Like I'm looking at this as an exit, not a buy strategy.
And you and I have been talking about this for months. Do you see
Yeah.
chips today?
But I'm just like, I own some of the chip stocks and they're running, but so what? I'm using this as an opportunity to sell my chip stocks. I'm not buying them. I'm taking the other side of your trade. I'm lightening the load on the long side because the next leg down, Gianni, if they take out 6,300, you're not getting this thing up anymore. We're done for the year. That's it. That's the last
Oh,
bastion.
we will see.
It's 6,200 is my line in the sand. If we're above 6,200, we can still stay up here. But if we
Yes,
take out 6,200, I just don't want to know how far this thing's going to fall. I don't know, but we'll find out.
we will see.
All right, man. Sorry for Detroit's loss.
Yeah, it happens.
And it's a double losing weekend for Gianni because the Lions got their butt kicked last night by the Chiefs and the Tigers lost, so there ain't no World Series for you. This is a rough weekend for Detroit. I'm sorry about that.
Yeah, it's okay. I'll let them lose. That's fine.
Okay, I'm sorry to give you hell. See you later.
That's okay.
Bye.
Take care, bro. All right, Theo traders. Welcome back. We are live. It is Monday.